Welcome to the Retire with Purpose podcast. This is your host, Casey Weade, and this is a special opportunity for you to not just get behind the scenes, as we often allow you to do during these live podcast posts that we do and recordings that we're doing. We're doing something a little different today that I'm really excited about. We have our first live in-studio guest. Usually we're meeting over Zoom, and we have Fritz Gilbert here with us today. Fritz reached out to me and said, "Hey, Casey, I'm going to be in town, hanging out, doing a board meeting here and there." He works the whole 4 days a week now.
No, 4 days a year. Don't exaggerate. 4 days a year.
You get 4 days a year, and Fritz just so happens to be in town right now and reached out, said, "Hey, I want to get together and have a conversation." I said, well, instead of just having a conversation, why don't we actually take this live to our YouTube channel and our Facebook channel? First time we've ever done this. And so I'm really excited to share this live in-studio appearance with you. This is a great opportunity to present your unique questions to our world-class guests. Fritz has been one of our most popular podcast guests, but our fifth most viewed YouTube video of all time. He's garnered thousands upon thousands of views, and I'm excited to recreate that here today and just go a little bit deeper into what makes Fritz so darn special as a real life retiree here. Fritz joined us on episode number 192 of the podcast. So I would encourage you, if you haven't listened to that, go back, listen to episode number 192 of the podcast. You'll get a really good feel for who Fritz is, what makes him drive, and what makes his blog so popular. He has the Retirement Manifesto blog. The Retirement Manifesto blog has won many awards. It's been voted the best retirement blog that's out there today. And so great place to just dive deep into both the financial and non-financial aspects of retirement. What's really unique about Fritz is that he is not just a retiree, but he's been chronicling his whole retirement experience. He started doing the blog, 5 years ago? 7 now.
Yeah, it's pushing 7. Yeah.
It was 5 years when we first interviewed.
Right.
Now it's a couple years later where we're sitting down and going to see how the last couple of years have gone. But I think you started doing the blog, was it 2 years prior?
It was 3 years before my retirement date, and now I've been retired 4 years. So it's almost balanced on both sides of retirement. So it's been preparation for, transition into, and now life of retirement. So it's been fun.
And
a big part of the journey.
Anything like that. What I've seen from retirement bloggers is they're blogging post-retirement, or they're blogging pre-retirement and talking, and maybe they don't even have intentions of retiring. It's just talking about retirement. You've done both sides of it. So it's great to be able to dive into some of those things. We also have a copy of your book sitting here on the table, Keys to a Successful Retirement. If we want to hold it up and show everybody the book. So this is...
Thanks for the shout out.
Keys to a Successful Retirement, Staying Happy and Active and Productive in Your Retired Years. We're going to be giving away copies of this book to you today. So if you would like to get a copy of Keys to a Successful Retirement, all you have to do is write an honest rating and review of the podcast over on iTunes and shoot us an email at info@howardbailey.com, or just give us a call, 866-482-9559, and we will send you out a copy of Keys to a Successful Retirement. And
Autographed.
Fritz has committed to autographing at least one copy. So you want to be the first person to jump on that in order to get that unique autographed copy that you can only get right here with us today. So Fritz, before we get started, I just want to make sure everyone that's out there that's watching right now knows that they can ask any question that they want. It could be financial, it could be non-financial, it could cover the gambit, anything. Last time we got together, we talked about marriage and retirement. We talked about RV travels. We talked about volunteer work. And you're also working in retirement, very little, but you still are making some good income.
4 days a week. I've heard I'm working 4 days a week now, so I don't know how that changed. But no. Anything's fair game. I'm totally open to.
And a lot of
you want to talk about
a lot of the questions we saw come in prior to you getting there, prior to you getting here, because we reach out to all our weekend reading subscribers and ask them if they want to submit questions prior. A lot of those questions came in. They were around what's going on in the current environment, inflation, and interest rates, and the market, and what's Fritz doing? How's he making adjustments? And I know you and I talked a little bit as well when you got here that you've got some friends that are asking you some of these same questions. So I just want to kick it off with that. If you've got a question, drop it in the comments section. But in the meantime, I want to go to one of our weekend reading subscribers that submitted a question. So we've got a question that was submitted from Janet. Janet, thank you for your question. Janet says, my husband and I are on the verge of retirement, given the situation we find ourselves in, high inflation, plunging stock market, would you advise us to continue working? I wanted to present this question to you, not just because it came in, it's a very relevant question, obviously, but you've also had a fairly recent blog post around this very topic, the top 5 most important factors in making that decision. None of those top 5 said anything about inflation or a stock market. So how would you address this question with Jana?
Yeah, and it's a question on a lot of people's minds, obviously, with volatility and what's going on right now. First of all, thanks for having me in the studio. This is an awesome setup. I love the Howard Bailey broadcasting over here. It's a very professional look you guys have, so I'm impressed. So thanks for having me here.
I'm happy to have you. Excited.
And as for the question, I think, really when you're looking at retirement, it's a math problem. Most importantly, right? It's not, hey, I'm 65, I want to get out, or hey, I'm really tired of my job, I want to get out. That age-related stuff has nothing to do with the factors you've got to, take into consideration. You've got to look at, and most people don't, you've got to look at a realistic spending estimate, because ultimately what you're trying to decide is, do the assets I've compiled over my 30-year working career, plus my Social Security, plus whatever side income you might have, are those sufficient to cover my spending? And really, when you talk about inflation and things like that, where does that go? That goes to the spending question. So it's all tied into what's your spending realistically, as best as you can do. What's it going to be in retirement? Because it's going to change when you're working, and you don't want to use the old rule of thumb. Oh, it's 80% of what you're spending now. Because what if you decide you want your retirement to be, worldwide travel, and you want to buy a second home? I mean, your spending is driven by what you want your retirement to be, right? So you've got to think about what you want your retirement to be, how that's going to affect the spending, and then look at the math. Obviously there's not enough detail in our question to say, yes, you should work the one more year, you shouldn't. But it comes down to, once you've done that equation and you're saying, okay, I'm at a 3.5% safe withdrawal rate, in a way, inflation doesn't matter, because over the long term, the stock market's been proven to keep up with inflation. And if that safe withdrawal rate calculation is based on many, many years of market volatility with inflation, with market returns, with bears, with bulls, and you've just got to trust the long term that those factors will offset each other if you've got the right asset allocation. So I think the other thing it points to is, you've got to have your cash bucket fully funded before you retire, right? So she's nowhere near having, I would say, a minimum of 3 years of cash. This year is the demonstration of why that matters. And if she's got a year and she's going to have to sell some stocks in order to be able to fund, maybe year 2, well, what if the market's still down in a year, right? You've got to have enough cash or cash-like investments that can give you time to not sell stocks in the downturn, or else you get nailed with a sequence of return risk.
You said a lot of things there.
Yeah,
so
there's a lot there,
we could take the question a lot of different ways. But I think what I first want to hit on is just the fact that it seems like, you talk about the 5 most important factors. You also talk about the least important factor being age. But it seems like a lot of the questions that we get when people first come in to talk with us, or they submit questions, they email us, they text us, they're often asking the wrong question. They're trying to make the decision based on, well, I don't feel like I should retire right now because of what's going on in Washington or politically. I don't feel like I should retire right now because, well, the stock market's down. I shouldn't retire because inflation's up, or I shouldn't retire because interest rates are going up. I shouldn't retire because I'm not on Medicare. I'm not on Social Security. You weren't on Social Security. You weren't on Medicare. You retired prior to that. Why do we have this tendency to want to make the decision not based on the facts that really apply to our own situation?
That's a good question. I think, who knows, right? It's probably a different reason for different people, but I think retirement is one of those things that's very heavily ingrained, that it's kind of age related. And you're thinking, okay, when I'm 65, I'll get Social Security. Well, I can retire then. That's irrelevant. What matters is, do you have enough income, and can you draw enough from your investments to cover your retirement spending? Where did I say Social Security in there, right? That's a factor in what your income flows are going to be. I retired at 55. We've got 10 years of private insurance we got to pay. I have no Social Security for 10 years, right? It's a math problem. So you've got to do the math and have that dictate it. I think the other thing I would say too, so it's a math question, and the math, it has to be driven by income and spending, right? That's the math equation. The other thing is, I think your initial focus is always on the financial, but I would argue, and what my book's about and what we've talked about before, and your whole Retire with Purpose, the non-financial has to get just as much attention as the financial. And that's
Yeah.
another area that a lot of people ask the wrong questions. They don't even realize that's a factor. And then they kind of, go into a whirlwind when they step off into retirement and they didn't think about all those non-financial aspects, and it can be disruptive.
Yeah. Well, and maybe Janet's in a situation that a lot of individuals find themselves in today that were planning on retiring this year or maybe in 6 months or
Yeah.
3 months, where they didn't build up that cash bucket. They didn't build up that buffer. They didn't put together a first leg of income, as you and I discussed, our personal kind of philosophies around
Yep.
income strategy when you first came in before we went live.
Yep.
But they haven't built up those things. And maybe today, let's just say Janet finds herself with 15 to 20% less in
Yep.
retirement savings than she had 6 months ago.
Right.
Does Janet need to wait for that to come back? Should she wait for that to come back? I mean, what's your philosophy around that? Is it still a numbers game? Does it matter if you've seen the stock market draw down or not? What if it draws down further? I mean, what are your thoughts?
And certainly emotionally, it's a huge factor, right? Because there's always that risk in the market, but when you're in the middle of a bear market, it's a lot more tangible, right? You see it, you're looking at your statements, and like you say, you're down a couple 100,000, whatever it is. It's a huge emotional anxiety. And I just did an interview with AARP. It'll be out, I think, in October, November. And one of the things we talked about was, is it appropriate to consider working one more year? Absolutely, it's appropriate, right? If you haven't done your homework, if you don't know that your financial numbers are where they're at, if you haven't built your cash reserve, you got to get that stuff done. Just jumping off blindly in the middle of a bear market without having your cash reserve, without really understanding your spending, without really understanding how much your withdrawal rate's going to be. Look at this. If you're at a 3.5% withdrawal rate right now with the bear market, man, you're golden, right? Because things will recover. If you were at 4.5% using your January portfolio, and now your portfolio is down 20%, guess what? You're probably over 5% withdrawal rate. Well, that tells you need to work one more year, right?
Yeah.
So there's various ways you can answer the question, but it really gets into what's your withdrawal rate going to be? And, do you have other prospects? The other thing I would encourage people, this is another thing I mentioned in the article, you should never retire with just a bare bones budget. You want to have some discretionary funds in there. You want to be able to go on vacation. You want to be able to live your life in retirement, right? So what I really encourage people to do is make sure that that spending number has some luxuries in it. And that can help with the anxiety, because if you retire and a bear market happens, or right now you got a bear market going on, that's okay. For the first 2 years, I'm not going to use that luxury spend that I had planned in there. I'm just going to use it to cover the essentials. I'm going to underspend a little bit of what I knew I could safely spend. That's fine, right? So there's a variety of ways to skin the cat, but it definitely increases the anxiety.
Well, you said a moment ago that don't forget about the non-financial aspects of retirement, the softer side of things. When you put together those 5 most important factors, number 1 was, do I have enough money? Number 2 was, are you mentally prepared for retirement? You could arguably move number 2 to number 1. And I say that for this very reason, right? The market's down, say 20%. Maybe you're down 20% today, but you hate your job. It's just dragging you through the mud. You're not enjoying life, but you go, I'm just going to wait 6 more months for it to come back. But a lot of people did that during the financial crisis. They did that, during the tech bubble, and they found themselves not 20% down, but then 50% down, and taking, 5 years, 7 years to get back to even. Now you're spending another 5 years in a job you don't really enjoy just to get back to even, when it doesn't really matter if you're back to even or not, because you've already come so far. Even if you're down 20% today, you're still doing pretty darn good over the last decade, right?
Exactly.
So if we made that non-financial decision that I want to retire for these reasons, this is what it would bring to my life, maybe we can kind of extract the emotional aspects of being down a little bit.
Yeah. Well, and it all comes into your frame of what time frame you look at. Look at me. I retired 5 years ago now, right? 4.5. And if you look at the market returns in the last 4 years, they've been way above average, right? So if you would have looked at the kind of the planning model I had used, even with the downturn, I'm probably still hundreds of thousands higher than what my spreadsheet would have said at the time, because I never would have assumed 20% market growth for 3 years in a row, right? I was probably using 8 to 10, conservative estimate, probably 8. And so it all comes down to, what are your assumptions when you look at this going forward? And you can't just get too focused on a very short microcosm of time, because it'll drive you crazy, right? Same with things. And that's why I like the bucket strategy, in terms of thinking in terms of how much cash do you want to keep liquid. And when the market's doing well, as you're spending out of that bucket, it's forcing you to refill it, and you're selling stocks when the markets are up, or you're selling bonds. Not this year's kind of weird with them both being down, but right now I'm just pulling down bucket one. I've got 3 years. I'm patient. I've got time to wait. So I think having a methodology that forces you to skim some of those profits when the markets are good and be able to hold your breath when the markets are down is absolutely critical on the financial side of retirement.
When it's my dad used to say this a lot. He'd say, well, you got $1 million today, and in 12 months, if that's worth $500,000, will that change your life? People say, absolutely. If you have $1 million and now it's worth $800,000, which some are probably in that situation today, does that change your life? And if you do the math and go, actually, it doesn't change my life that I have $800,000 instead of $1 million. I can still live the retirement that I wanted to live. But if that 800,000 turns into 500,000, I won't be able to retire for a number of years.
Right.
Then maybe it's okay to go ahead and execute the retirement strategy. Maybe you don't get as back to even as quickly as you might have if you would have waited, but you could be putting yourself through a lot psychologically, which can ultimately shorten your life at the same time.
Well, and you have to look at the opportunity cost. The way I always look at it, if you've got, let's just use easy math. Let's say you're 65 and you're debating working one more year. Well, I would argue, how old do you realistically think you're going to still be able to hike Mount Kilimanjaro or whatever you want to do, right? Let's say 75. So 65 to 75 is 10 years. You work one more year. That's not just one more year of your life. That's 10% of your remaining active years. So you've got to think about the opportunity cost of continuing to work, right? You're giving up the youngest you're ever going to be for the rest of your life. You're giving up that next year of your youngest year that you could really be enjoying retirement.
Yeah.
Just because of the emotion. I mean, look at your $1 million example. Well, if I tell you, okay, it's down to 800 now, but if you can just, have a cash reserve and you're not going to touch anything that's in the equity, and 3 years from now, chances are it's going to be $1.3 million, or, over $1 million. It'll rebound over 3 to 5 years, certainly. Okay. Then you're pulling down your cash. When the thing eventually recovers, your planning assumption was right. Yeah. You just didn't sell when it was down, which is the thing you really have to avoid, because that's where you run into the risk of running out of money, is if you're having to sell those stocks or bonds, in this case, in a down market. That's where you can really hurt yourself.
And we had Jeremy Siegel on the podcast here a couple of weeks ago, and he said, if you invest your money today in the market, then a year from now, chances are you're going to be pretty happy. 2 years from now, you're going to be really happy. And I think that's the case, right? If you can fill in that gap for a while and still retire, then you'll be okay. If you can put off making those withdrawals, and you'll get back to even, probably even happier a few years from now. You said 3 years of cash. I think that's going to throw some people off. Yeah, because we're often told, if you've been through Financial Peace University, Dave Ramsey's program, you often hear 3 to 6 months of cash reserves available in case of emergency. Do you adhere to that in any way? And why 3 years?
The 3 to 6 months, absolutely. But I would say while you're still working. Right? Because you've got income coming in. So you've got a short-term situation, you've got to deal with it. That's a different type of risk that you're managing while you're still working. Okay, you might lose your job. Maybe you'll have to get another job. There might be a gap of income. But when you retire, you're assuming no more income for life, right? The 3 to 6 months is no more income if I lose my job for a couple months until I can find another one, right? It's a short-term risk. And something major breaks and I've got to, buy a new car that I wasn't planning on. Okay, that's a short-term risk. In retirement, and the reason I say 3 years instead of 6 months, the way I view that liquidity bucket is that is insurance against having to sell stocks in a down market. So that's a longer exposure. Bear market, if you read the stuff Ben Carlson writes, he's done a really good series on the duration of the average bear market. 2 to 3 years, pretty common. Guess what? 2 to 3 years of cash, right? That's kind of the logic of why I like that number. Some people say, oh, way too much opportunity cost, no returns in a low interest rate environment. I'm not going to tie up that much cash. That's fine. To me, that money isn't there to make a return. That money is there to avoid incurring a loss.
It's there to avoid sequence of returns risk.
Exactly.
So do you separate those dollars from your emergency fund?
No.
Are there 3 years of cash to insulate you against sequence of returns, and then 3 to 6 months of emergency dollars?
No, basically I just looked at, and the other thing you need to think about as you're getting closer to retirement, let's say you're 5 years out and you've got 3 months of cash. Okay, that's fine. Totally appropriate. Well, by the time you're a year out from retirement, and you know you have to build that cash buffer up, if you wait until you're very close to retirement, and now you've got to somehow generate 3 years worth of cash, guess what? You're exposing yourself to sequence of return risk there, right? Even though you haven't retired yet, if you're going to have to sell some stocks to fund that bucket one. So what I encourage people to do, if you're 3 to 6 months and you're 5 years out, that's fine. When you get about 3 years out, start funneling stuff that you've been investing and move it into after-tax cash instead. Maybe you give up an IRA or a Roth, heaven forbid, but you've got to have liquidity in the after-tax account, especially if you're retiring before you have access to your, IRAs or 401ks. So you've got to really think through what's your strategy to build that liquidity from a 3 to 6 month totally appropriate buffer when you're working to a 2 to 3 year buffer by day one of retirement. And I would encourage people to do that over a couple of years.
Why would I liquidate portions of my IRA and move it into an after-tax account in cash versus just keeping the cash inside the IRA?
Well, you can do that if you have access to the IRA. You can incur taxes, right? So you got to think about that. I like to think of, we talk about asset allocation. You got to have stocks, you got to have bonds. You've also got to have tax allocation, especially as an early retiree. One of the big things I was really focused on, am I going to have enough after-tax liquidity to get to the age of 59 and a half when I can tie into my 401k, right? So having some money that's after-tax, and I wouldn't say move the IRA money to after-tax. What I would say is if you're a year from retirement and you have no cash saved, maybe you stop doing an IRA contribution and you move that to an after-tax cash investment. That's how I would do it.
Yeah, that's something that a lot of people overlook as they think about diversification from an asset allocation mix, diversifying away company-specific risks, things like that. But they don't think about tax diversification. So we often talk about tax diversification as our three buckets. We have our after-tax bucket, that 1099 bucket. Then you have your IRA bucket, all those tax-deferred dollars. Then you have your Roth IRA bucket, all those tax-free dollars. So we have our taxable, tax-deferred, tax-free. What's appropriate in the way of a balance between those three different buckets?
That's a really interesting topic. I could spend hours just talking on that. I think what you find, and I would assume most people that are close to retirement are, let's say, baby boomers, maybe, getting now into more of the trailing edge of baby boomers. But for all of us at my age, I'm 50. How old am I now? 59. Anybody in their late 50s, for the first 20 years of our working career, we didn't have a Roth available. All we had was that pre-tax IRA, and everybody's, contribute as much as you can. It reduces your taxes. It reduces your taxes. So most people my age, if you've been in a job with good 401k benefits and things like that, you're probably over levered or you have too much exposure to the before tax. I certainly did, because by the time the Roth came around, well, you're probably in a higher marginal tax bracket now because you've been working, you're well into your career. So the Roth contributions aren't necessarily the best thing to do. So at that point, you feel the pressure to do the before tax because it is a tax issue at that point, right? Because you're making more money. So you tend to increase that before tax IRA or 401k because it's kind of the only option you have. So most people, and I did a post on this, my retirement drawdown strategy, we had over 50% of our assets in pre-tax. So, if you're in that case, and I would say a lot of baby boomers are, put together a strategy before the required minimum distributions kick in at age 72 to intentionally every year move some of that pre-tax IRA or 401k into a Roth. And you do that up to your marginal income tax bracket. You get tax savings versus let's just wait until the RMDs kick in. You're forced to take a certain distribution regardless of tax structure. You're not necessarily optimizing it. So we have been doing Roth conversions every year.
To this day?
Yeah. I've done one every year since we retired. And actually, even in the last couple of years that I worked, I noticed that we were too heavily skewed to the pre-tax. So I sub-optimized my last couple of years of work, even though from a purely short-term tax optimization standpoint, it would have argued to do pre-tax. I said, I'm just going to take the tax hit now. I'm going to go ahead and put some in Roth.
Yeah, for the diversification benefits.
For the diversification.
Really for the flexibility of withdrawals, et cetera, and the risk of rising taxes, things such as that.
Exactly.
Yeah, and over the last couple of years, what's been your Roth conversion strategy? Do you have a strategy that you follow, that you check boxes and look for triggers? Yep.
I've got a very detailed, every year, I do this and I look at what's my expected income from, obviously my blog makes a little bit, my pension, investment returns, et cetera, a little bit of side money from the book or the board job, whatever. You put all that in and then I say, okay, how far below the next jump in tax rates am I? Let's say you're $50,000. I'll go ahead and watch that all year to make sure I didn't miss something. And as I get into the fourth quarter, I'll target that $50,000 to get me right up to that X tax bracket. And if you look at the tax rates right now since 2018 for joint married file or joint filing, jointly
married filing jointly.
Thank you.
Yeah,
Wow.
you got 20%. Yeah.
Let's do an edit. Oh, wait, we're live. We can't do that. They're tremendously favorable right now. And those are set to expire in 2025 if they're not renewed. So, there may be a limited window here. Look at I wrote a post and I did a graph with the old tax rate and the new tax rate. And you see over $150,000 income, it's a huge gap. Yeah. And you've got to think, chances are it will start going up. Everybody's got to make their own opinion, can't predict the future, but taking advantage of that 2018 tax law is something that everybody should be looking at while they can.
Yeah, we're getting about a 20% tax savings today. Right. We've never had more certainty that they're going up in the future because they're expiring in 2026. So we need to be doing something about that. And I love the concept. We often talk about tax diversification. Yep. So I want to go to a question that we had from John on our Facebook that was just sent over to me.
Perfect. Hey, John.
And I think John has a really good question that pertains and relates to our conversation before we went live. So I think we can go back and revisit that a little bit. But it's kind of the other side of the question here with Janet. Janet's having this question around, well, should I retire? I'm at retirement. What should I do right now with the market being down, inflation's up, plunging stock market? What do I do? And then you have John here, who's 20 years out from retirement. So John says, what's your advice for someone that is 20 years from retirement besides, keywords besides, just keep saving, right? That's probably the most annoying thing that someone that's 20 years out from retirement can hear. What should I do? Save more. But the reality is it's pretty true, right? I had my two sister-in-laws in town this past weekend, and they were both asking what they should do. And it's like, save more. Right? and it is. I mean, there's that. But then having the conversation about Roth and asset allocation and getting into some of those pieces. But what are some of the things that you really like to share with someone that's 20 years out, maybe that you missed out on, that you wish you would have done?
Well, the one thing I will say is you should be high-fiving yourself all the way to the bank. You want a rip-roaring bear market. You want a 75% crash in the market. If you're less than 50, less than 45, you want the wheels to fall off this thing, right? And you want to save as much as you can save. Back to your point, what I did when I worked from 81 to whatever it was 4 years ago. So I went through probably 3 pretty significant bear markets. And when the market was really down, I would actually increase my 401k withdrawals. I would say, I'll just tuck in on the budget a little bit and I'll throw a little bit more in there, a couple percent, or I'd look at asset allocation and rebalance. If you, look at your asset allocation in a down market, if you've got other assets, that's not a bad way to buy at the bottom as well. Using a rebalancing strategy will force you to buy when the markets are down and force you to sell when the markets are up. So check your asset allocation in addition to saving more, but look at a short-term bump in your savings rate. There were guys back in 08 that were, we're going to mortgage the house. And some guys did, right? They took all the cash they could get because they knew it was just a horrible bear market. It couldn't last. And they doubled their money in a couple of years, right? So that's uber aggressive. But you definitely, if you're ever going to save and you're 50, 45 or younger, save as hard as you can during the bear market because that's the best deal you'll ever get on the side.
Right, you can accelerate those contributions even to 529s for the kids or your HSA. Except if you're going to make end of the year contributions, why not do it when the market's down 20%? Or I know for myself this year, I'm 20 years out from retirement. If I ever retire, it's going to be a long time, but it's going to be a long time from now. So I think it's relatable. I've done Roth conversions last year. Did Roth conversions, so I don't have any more traditionals. I can't do any more Roth
good
conversions.
For you. That's awesome. That'll serve you well as you get older.
Did them all during the COVID drawdown.
Perfect.
But this year I did some tax loss harvesting. So I was able to liquidate some individual securities I'd purchased at the beginning of the year, reallocate them to ETFs. I can buy back in, avoid the wash sale rule, put some cash to work, and, as we said, accelerate contributions. So I think there are things that you can do during bear markets that I think you've done a good job mentioning. But what about from a financial planning standpoint? And we're talking about Janet, and you talked about your 5 years out from retirement, you start building what Michael Kitts has referred to as a bond tent. You remember that blog?
Yeah, I do.
Kitts had?
Yeah.
One of my favorite blog posts.
That's the reverse glide path too, isn't it? The same
reverse
concept?
glide path and the bond tent. And I just think that just presented such a good visual of what we should be doing. And it was so contrary to popular belief that 5 years leading up to retirement, then we're in that retirement red zone and we're starting to reallocate from some of those equities to bonds. It could be reallocating from more aggressive positions to less aggressive positions as well, but building up that fixed income and then spending down that fixed income over the first 10 years of retirement while that equity portion of your portfolio grows.
Exactly.
So as retirement goes on, you actually have more equities when you're 80 than when you were 60.
Right.
For that matter.
Right. Yep.
So just love that concept.
I do too.
And I wonder for someone like John, I mean, how does he think about this? And does he think about that at all, in your opinion? Is it all about saving aggressively in aggressive portfolios, equities, and things such as that? Or is there something else to consider from a planning standpoint?
It really does get into your time frame. And when you say John's 20 years out, that to me, and we talked about this before we started recording, we have a little bit difference of view on this. I think 3 to 6 months is totally sufficient until you're 2 to 3 years out. If he's 20 years out, I don't think an aggressive equity heavy allocation is inappropriate at all.
Sure.
He's got to have the right risk tolerance and capacity and capability,
attitude,
attitude, all that. He's got to understand and not sell in a down market. But as long as he can handle the volatility, there's no problem being 80+% stocks.
Yeah.
What you don't want to do, and this gets to Kitts' bond tent, is you don't want to be 80% stocks the day you retire, because then you get stuck like we are right now in a down market and all your money was sitting there and that's what you planned on using to spend in retirement. And now you don't want to sell it because you're in a down market. So a bond structure think of CDs. A lot of people can get their head around CDs. It's the same concept. If you've got a CD that's going to retire or expire in 2026, you got another one in 2027, you got another one in 2028. And okay, I've got those years. Doesn't matter what happens to the market, my CD is going to mature. You can do the same thing with bonds. And that's basically the bond tent idea. Yeah.
And it's different. John's saying that he's 20 years out. And that's one thing that's very clear, that John doesn't have enough saved, right? Yeah. However, let's say you have a young individual that is 20 years out from wanting to retire, but they may decide they want to retire tomorrow. They just get fed up with their boss, right? Or they want to sell their business because they had a bad day, And that's where we talk about being job optional and not being in retirement. You're job optional. And I think this relates back to kind of your situation as well. You're still working, you're still earning some income. So you don't need the withdrawals from your portfolio that the average retiree might, that needs all of the income from their portfolio. But let's say that John has enough to retire today. For me personally, I like to know that if I want to pull the trigger and retire tomorrow, I can just do it. I can just quit tomorrow and I would have my 5 to 10 year, personally, I like 5 to 10 year income bucket that I know is safe, principal protected dollars that I could kick on while I wait for everything else to continue to grow that is aggressively allocated. And what I've found in working with younger individuals like John, like myself, and like other clients that I've worked with over the years, is when we build this plan and they get to this place where they go, oh, I could retire tomorrow, and it doesn't matter what happens in the markets. They never end up retiring and they end up making more money than ever.
Exactly. Yeah. Well, I'll tell you a couple of things that come to mind as you talk through that. One is John may think he's working 20 more years. 60% of people get forced into retirement earlier than they planned on. Now, not 20 years earlier, obviously, but most people, I'm going to work till 65 because I haven't saved anything. And guess what? You lose your job, or your spouse gets sick and you got to take more time off, whatever, right? A lot of it's health related. A lot of it's job related. As you get older, your chances of losing your job goes up, right? So 60% of people get forced into retirement earlier than they would have otherwise chosen to retire. So think, I've got some time to put this in place. You might not have as much time as you think based on the odds. And number two, if you love your job, and John loves his job, right? Well, most people love their jobs when they're, early 40s, right? That's,
Sure.
hey, you're in your peak of your career, everything's great. Most people get pretty tired of their jobs by the time they're in the 50s, right? So you
Yeah.
may love it now, but the chances that you're going to continue to love it for those whole 20 years, probably odds probably aren't in your favor, right? Not to be pessimist, but just realist. So,
Well, and that's what I love about the FIRE movement.
Yeah.
I'm not a huge fan of like everything that comes out of there, but as the FIRE movement goes, it gets people to create financial independence as early as possible. So they aggressively save, where it might only take John 5-7 years to get to a job optional point where they could be financially independent and not need to continue to work, and then spend more for the next 15 years and really enjoy life, or go out and start your own business, or go out and find a new job. I think that speaks to your point that a lot of people don't actually make it to the retirement date. So we should be trying to get to a job optional as quickly as possible.
Absolutely. And I think too, job optional is a great goal to have, right? Absolutely. We should all strive to be there. The reality of it is there is a retirement problem in America. You see clients every day. You probably see this. The vast majority of people have undersaved. Yeah. So it's easy to say that, but and probably for your listeners and the viewers, a higher percentage of those are in a better place. They're planners. They pay attention to this stuff. But the vast majority of people,
they're not listening to this,
but they're not listening to the show.
60 years old.
Right.
And that's the issue.
Yeah.
And if we were starting and thinking about this when we were 25, most people, I mean, really, almost everybody could do it. If they started early enough, they just don't really get into this till they're in their mid 50s and go, well, I can't do that. I've got to wait 10 more years. And that's true. Absolutely.
The amazingly simple math of early retirement, right? Mr. Money Mustache. We talked about him earlier. It's a grid, and you save X percent, you can retire in X number of years. And man, that thing is accurate. It really works.
It's a math equation.
Yeah. So you can retire in your 40s. Absolutely. I've got friends that retired in their 30s and they're loving life. And now being retired, man, I love it. You want to get to retirement, trust me. So save aggressively. And, I don't have a problem if you're 20 years out, legitimately 20 years out, and you really haven't saved much, get your 3 to 6 month emergency reserve. But then you get into what's your risk tolerance, what's your asset allocation, whether you start building this 5-year buffer, 3-year buffer, 10 years out, 20 years out, or 2 years out, gets into your personal risk profile. How much opportunity cost do you want to take by not having that potential growth in equities? That comes down to a personal decision, really. There's no wrong answer.
It's easy to say it's a math equation and this is what you should do. But I know I'm a unique individual and I am not like people my age. I'm not comfortable being 100% equities and having 3 to 6 months cash. I wouldn't be able to sleep at night and I don't want to live a life like that. Right. I know what I need. And I think for John, he's got to figure out what he needs, right? What's unique to him. We had another cash question. We have a question from Bobby in Scottsboro, Alabama. Bobby says, I have about 6 years in the cash bucket. I have about 6 years in the cash bucket. Should I reduce that to 3? So I think this goes back to speaking to that thought process around what makes you unique, right?
Yeah. And it's hard to answer general questions without the detail, Bobby. By the way, you're a neighbor. I live in Georgia, so go Bama, roll Tide. But I think if you're 6 years of cash, and I don't know what your total portfolio is, what your withdrawal rate or anything else, but one thing you can think about, and this is what I did back in the downturn a couple of years ago in 2020, the COVID downturn. I had like 5 or 6 years of cash, and I had too much cash. I mean, in my mind, I didn't want to have that much cash. So during the bear market, and I wrote a post about this, I was moving that cash into stocks, and I basically set a target every time the market went down 5%. I would take 1% of my net worth and move it from cash into stocks. So I was using, and there was a method to it. I didn't want to put it all in early and have it keep going down. I wasn't trying to time the market. If you look, it really is a rebalancing. If you looked at the asset allocation, it kind of stayed the same because stocks were going down so much and I was moving some of the cash over. So you could have a strategy where you say, okay, I'm comfortable with 3 years. Heck, we're a year into this bear market now. You're a year less risk. You could take a year of that cash and have a strategy where you lay it into the market over the next 6 months based on, every 5% decline in the market, I'm going to go ahead and move a little bit of it. You could reduce that strategically and get more equity exposure if you felt like you were oversaving. There's no magic number. It just comes down to personal preference.
Well, and I think it comes down to tools too. Nobody needs 6 years of cash. I would argue that nobody needs 3 years of cash, with the right tools. I think having 6 to 12 months of your expenses in real cash, right? That could be cash from the mattress, could be a money market for that matter, or it could be your bank account. You have cash you have access to. I think it's unlikely that you need access to a large lump sum beyond that, maybe 1 to 2 years in pure cash. But then for somebody like Bobby, who has 6 years, why not keep 12 months of that in cash and take the other 5 years, and you could build a bond ladder. You could have it in short duration bond funds. You could buy a 5-year fixed annuity today that's paying 4.5%. Right. And then you could take 10% out if you want to take it out every year and then reallocate it back to that cash bucket in 5 years. You can do that every year and kind of ladder those things out. 3 to 5 year fixed accounts paying anywhere from 3.5% to 4.5%. That's better than sitting in cash. But your dry powder discussion there is, that's what we talk about a lot on the podcast. Going into retirement, it's kind of, I have my own reasons for why I think that this is ignored largely by financial professionals, but I think it makes sense to always have some dry powder for experiences like this. Bobby's in the situation where he could take 3 years of cash that's probably going to be $150,000, $250,000. He could allocate that to a market that's down and create an even bigger retirement, and then continue to work that into a system over time. We should all be going into retirement with some dry powder.
And think about this. If those are years 4, 5, and 6 of cash, well, he doesn't need that until 4 years from now at the soonest, right? So if you're moving years 4, 5, and 6 into something a little bit higher risk, but potentially higher return, well, you got 4 years kind of at the earliest. So do you think, given how much the market's already come down, what are the risks that it's going to be lower in 4 years? Probably not very high, right? Because eventually it will recover. So your risk goes down as you're moving those 4, 5, and 6 years of cash. Those are less risky years. You don't necessarily need the cash because the risk is lower.
And you said you have a system, or you had a system during the COVID years for how you were going to allocate some of that additional cash to the market. Can you elaborate? What was that system?
I called it a strategy for buying into the bear market. You can find it on the blog, but basically, and I put the whole chart together. I showed, I don't know, a year or two of S&P 500, I think it was. And this all started, as I mentioned, I've been through 3 or 4 bear markets during my career. And I tended to be one of these guys that, and I think a lot of people do this, early investors. The market's been on a roll for 3 or 4 years. You're really used to a good bull market, and then it drops a little bit and you get excited and you start throwing cash in it, right? But those of us who have been through a real dramatic extended bear market know that it's catching the falling knife, right? It can just keep going and going and going. And you're like, oh, I shot all my dry powder and it's down another 25, 30% from where I went in. So I wanted to avoid that, right? I'm more risk adverse being retired now. So what I did is I looked at my asset allocation, and I always target 50 to 60% equities. And I was down near the lower end of that. So I said, okay, I don't want to throw it all in early, and I don't necessarily need to change my asset allocation, but I don't want to go below 50. And I had a little extra cash. So basically, as the market started going down, I said, okay, when it gets down 10%, I'm going to move 1% of my net worth. Do the math, right? And if you're at a 50% stock and the market goes down 10%, it's half of your portfolio. Your asset allocation, stocks will drop 5%. So you'll go from 50 to 45%. You're under allocated on stocks now. So there's a logic to how, and I laid it all out in that post, but basically every 10% drop in the market, and I think I moved to 5% after the first 10 or 15 down in the market, I started moving to 5% tranches, and I started increasing the percent of my net worth. So on the March 23rd, I think it turned out to be the lowest point of the market, and I wasn't timing the market. It's just that was another big down day. I moved 2% of my net worth, and that money probably doubled in less than a year. Right? Because the market came back so quick from that bear. Cool. So having a strategy where you're not timing the market, you're just intentionally rebalancing, and you've predefined what those buy points will be. And I've had a reader, he said, man, I'm using it this time. It's great. He said, I set up a Yahoo Finance alert for the S&P 500 ticker, and it just pops up on my phone when it's down 5% from the last day I bought. So, time to move another, 1% or whatever you want to move in. It's a good way to take the emotion out of it.
Oh yeah. Well, and you're a pretty optimistic guy, right?
I'm optimistic.
You're an optimistic fella.
Yeah.
And I think it takes some optimism to do that. Maybe a considerable amount of optimism if you're going to turn on the news channel. You seem to be able to maintain optimism during difficult times, where I see a lot of other individuals that can't, right? And that takes blocking out the noise, but you're still very in tune with what's going on in the markets.
Yep.
And that means you're still paying attention to the news. You're still reading
Yep.
the news. You're still probably reading the Wall Street Journal and CNBC. Yep. You're still consuming this information about what's going on in the markets. And it could very quickly put you in a doom and gloom situation where you go, oh, I'm not going to put anything in this market because it's going to get a whole lot worse. But there's also other articles out there, or listen to what Jeremy Siegel said, right? It's like, hey, go in right now. You won't be disappointed. So you can take that to the other direction and pay attention and consume that information and make, an irrational or a rash decision on the other side of things.
Yeah, you could probably just disconnect from all news and it wouldn't really hurt you. You shouldn't be changing your investment strategy based on the headlines, right? And it's easy to get caught up in that, especially when the sky is falling. Hey, it gets clicks, right? You get these big, sexy headlines about a market collapse and people read it. And that can ultimately, when everybody kind of, no way I'm going to get in the market. Well, that's when you really want to get in, right? By the time everybody's just capitulated and they're done with the stock market, that's typically the bottom of the bear. So you can't let that emotional drama. I have had no anxiety in this whole bear market. It's been 7 months going. It doesn't bother me in the least. I got 3 years of cash. I know we had a little bit of luxury built into our spending plan. So worst case, we can knock that off. Hey, inflation's up a little bit. Okay, fine. But I was at a 3% withdrawal rate. I know I can, and I've got, so you've got to keep that longer term perspective and not just react to all the noise. It'll drive you crazy. And it's just not a good way to live life.
How do you, I'm sure you know people like this or have friends like this, people that probably reach out to you for your blog and want to tell you just how bad things are going to get and that things are completely falling apart. You could name a million different things, right?
This time is different. This time is different, but it's horrible. Yeah.
How do you respond to the negative mindset that someone has? Is it even possible to shift that?
I don't know if it is, but what I encourage people, think through if you would have been alive in 1941 or whenever Pearl Harbor happened, right? And you think about the traumatic events that have happened in this world over the last 100 years, huge depression, right? Massive, massive economic collapse. And yet over that 100 years, stocks have earned 10%, right? It's the market has proved resilient in much, much worse economic times than we're facing today. So why would we think suddenly, the market's not going to improve? Yeah, it might take longer because I'm a big reversion to the means guy, and we've had a lot of years above average. So I wouldn't be surprised if the next 5-year returns for stocks are 1%, 2%, 3%. Wouldn't surprise me in the least. But I think if you do this rebalancing and you're, keeping an eye on that, and when the market's down, you're just focusing on that asset allocation. If you get below your minimum, you're putting a little bit in. If you take advantage of those rebalancing moments, even if the market's 2-3%, maybe you'll get 4 or 5%. But then 10 years you'll be back at 10%, right? But you've had so many good years. You've got to expect, and Vanguard did a nice study on that. I think their growth forecast for the next 10 years for stocks, U.S. stocks, was like 3%, right? You should have a subdued outlook. That's not being negative or the sky is falling. That's just being a realist based on how incredibly above average returns we've had, for the last 10 years.
Yeah.
So,
and we're talking about a period in time, right? When you look at this, people just hear that stock market just averaged 6-10% a year. Yes, it does. But there still have been periods like this where we've seen 10-year returns in the 1% range or zero for that matter. It does happen. But when we talk about long-term, I think we often get the long-term time frame wrong.
Yeah,
right? We think long term is 5 years, 12 months.
Exactly. Yeah. Or I want to retire next year, so it's got to recover by next year, right? It doesn't work that way.
Right,
And I would argue, really, if you look at real returns, with inflation being up right now, I think that's probably going to last a while, right? There's a lot of drivers behind that. So real returns could be, you could have negative real returns on an inflation adjusted basis. So again, that doesn't drive how we live our life. That's just a reality of being exposed to stocks. And if you're not comfortable with that uncertainty, well, buy an annuity. I mean, there's other ways you can go about it where you can eliminate all your risk. You'll know what you've got to spend, and you can still enjoy your life, right? There's different scenarios, there's different personalities, and there's a myriad of tools available that can line up with that, right?
There's so many different ways to plan.
Yeah. It's not like, I've got to be in the stock market. Well, if you're not sleeping at night and you're really nervous and you're, then take a less aggressive approach and live with whatever your results can be, because now it's a fixed income type strategy. Okay, it's lower risk, although I'd argue you have a higher inflation risk over the long term.
Sure.
Now can you keep up with inflation, right? So there's always a risk.
Yeah, there's always a risk either way. We just have to find the risks that we're comfortable with living with, right? And that means finding the right tool and the right advisor. Hey, we got together originally about 2 years ago, and it was about 2 years prior to that you retired. So it's been about 4 years now. When we first met, you were just talking about how great life was, that you haven't had a honeymoon period. The first 2 years have just been total bliss. You've been enjoying every second, traveling in your RV, doing your blogging, coming out and doing things like this. And it's just been a great time. But we often hear that there's a honeymoon period, right? The honeymoon period lasts 12, 24 months. I mean, it's different for everybody. I would say now you're 4 years in, the honeymoon period should have ended by now.
Yeah, I've thought a lot about this pre-retirement, during retirement, as I went through it the last 4 years. I've written posts actually, like I did a whole retirement reality series where every 6 months to a year, I'm kind of giving an update on what's retirement like and how's it compare to what I expected it would be. And it's definitely different at 4 years than it was at a year, 2 years. No doubt there's a honeymoon period. But I think I didn't have the more traditional honeymoon period. And what I mean by that, I think a more traditional honeymoon environment is something like this. You're not really thinking about your purpose in your life after retirement. You're just, man, I'm so tired of my job. I just want to get out. And then you get out and you're like, I'm free. This is great. Right. And you're on cloud 9, but you haven't put in time and focus on that purpose question. So the first 6 months are bliss. You're loving life. About 6 months to maybe 12 months, it gets wonky, when you start realizing there's something missing. And hey, some of that stuff I got from work, all my friends were there and I can't do anything with anybody because all my friends are working now. So I'm kind of bored. That's kind of a more traditional path. And that's when the honeymoon period ends and you suddenly have to answer this question of purpose. I think because I did so much work thinking about the purpose on the front side, I didn't really have that transition. So I was, nirvana, really happy the first 6 months to a year, but it hasn't had a big corresponding reduction. I've continued to really enjoy this stage in life. It's a great time to be, retired.
Well, and I think a good chunk of why it's been so enjoyable for you is not just that time spent, preparing financially for retirement and also psychologically, but you've actually spent some money in retirement.
Yeah.
You've actually done some things, right? You bought the RV, you travel quite a bit and you enjoy life and you're not afraid to spend. But you had written a blog post a while back. I think this is what holds a lot of retirees back from living that big life in retirement, is learning to spend in retirement and just enjoying what you've worked so hard for. You wrote 5 tips for learning to spend in retirement. But before we get into any kind of tips you might have for someone learning to spend in retirement, why is it that we have this obstacle? And I've had this conversation twice in the last week with different individuals. One being a longtime client that every 3 months we get together and we talk about how he should spend and enjoy things. And this is someone that has more than enough to do anything he could ever imagine doing in life. He travels a lot and he'll do intercontinental flights, and he knows he could fly first class, but he won't do it. And there's not a legacy goal in mind at all. It's just hard for him to get over that hump and actually feel like it's okay to actually spend at this time in life. So there's a lot of people that struggle with this. What do you think the core reason is that so many retirees really struggle with actually going out and spending those dollars?
And I think you shared this post with your newsletter, so I appreciate that when it came out. It was a pretty popular post, and there's actually a name for it. I can't remember what, but there is a name for those people that, and it's very, very common. Now, again, we talked earlier about how the people that aren't listening to your podcast are the ones that should, right? They're not saving enough. They're not getting ready. Well, this topic is for your listeners, because the people that tend to not be able to spend are the ones who have been conscientious. They've been saving aggressively. They really know this stuff. They've managed it. They're the ones that can spend, but they've had a 30 plus year ingrained habit of saving. And that's why they were still making money. So now you take that emotional anxiety of not making money, combine it with a 30-year habit of saving. And it's just really hard to break that habit. You're responsible. You got here on purpose, and you got here by design.
So do we go out and find some spendthrift friends? Is that? Find somebody to help.
That's it. Go spend my money for me. No, number one is recognize it. right? You've got to recognize, hey, I want my retirement to be a time that I can enjoy life and not worry about if I can afford, first class tickets to Europe. I'm not going to, curl up in a coach seat when I can lay flat, right? I can afford it. So as you prepare mentally for retirement, I think one of the things you need to think about is, do I want to be able to spend without guilt? Is that a goal that I want to have? Or do I want to sit there and worry about, every single time I go to a restaurant, I'm going to order the cheaper thing? Hey, come on, you're saving $2. You got $1 million, live life a little, right? So I think recognizing that that's something you're going to have to address is the first thing. And it's really important. And then the second thing is, if you can automate a spending level. So in my case, we have a 3.5% safe withdrawal rate kind of ceiling that I work with. I set up a paycheck every month that comes out of our money market fund into our checking account. If the money's in the checking account, we can spend it.
Yeah.
No budgeting, no work to do. And guess what? If you don't spend it over 6 months, that checking account's getting bigger, right? You see it, it's visible. And you're like, hey, there's no reason to save anymore, right? You've already saved. You don't have to save retirement income. That doesn't even make sense, right? Your saving years are over. That's accumulation mentality. You're in decumulation mentality. So you've got to be comfortable. So set up a paycheck and spend it. And if it's starting to grow, well, then get involved with a charity, give some money away, help somebody out, force yourself to spend up to that safe withdrawal rate, because it is a safe withdrawal rate. You can spend it safely, but it's a hard habit to break.
Well, that's what I often find when we're working with someone in this situation is I just need to start giving them the money, right? Just turn on the button and turn on the spigot so it's actually hitting their account every month.
That helps.
And once it's actually there every month, after a while, you see them start to spend those dollars. And that's what you've done, is you've set up a systematic withdrawal of dollars that you may not even need, right? That, hey, if they're there, though, I feel much more comfortable with spending.
Yeah.
I had a conversation at a Front Row Dads retreat, a dads group that I'm part of a while back. And
I saw that on your computer.
Yeah, it's a great group, a great podcast, by the way.
Yeah.
And one of the guys said, he asked, do you look at the prices on the menu before you order something for dinner? Do you look at the prices on the menu?
I do, lifelong habit, but I don't let it influence my decision. I might still wince a little bit, but I'll get the salmon, but so I still, it's 35-year habit, right? I can't not look at the prices.
As he said, well, I said, yeah, I still look at the prices. He said, well, why? And I said, it's responsible to actually know what you're paying for something. He said, well, that's a poverty mentality. I don't know if it is.
Here's a thought for you. Think if a restaurant had a menu with no prices listed, and you were just free to look based on what most appealed to you, and it didn't matter what it cost. Well, that's our reality, right? When you get into retirement, if you're doing a safe withdrawal rate, assuming you're not going crazy, obviously, have some mechanism to keep yourself in the guardrails, but you should have a menu without prices on it.
Yeah. And I won't let it influence whether I get what I want or not anymore. I did for a long time. It was up until a few years ago. I was able to loosen up a little bit, but I've come from multi-generations of tightwads. So it's a little hard for me, but I've gotten a lot better at it. And I still think I want to look at the prices because, well, the one that's more expensive probably is better anyways, right?
Yeah. Well, I'll tell you something else too, is it's so counterintuitive to give yourself that freedom to spend. But the vast majority, somebody said this to me and it really resonated with me and it stuck with me. I would bet almost every one of your listeners is going to die with a lot more money than they think they're going to have, right? Over time, the market's going to do well. Your spending is going to go down as you get older, right? Almost nobody, and Mr. Money Mustache late article, why you'll never die without money or whatever, why you'll never outlive your money, most recent post. That's a real thing. I'm seeing it. Of course, the market's been way above in excess of returns, right? Okay, now we're having a slight correction, but in the longer term of things, we're still way up. So everybody tends to plan for the worst case, but the worst case almost never happens.
Super unlikely. Right.
But the whole safe withdrawal rate, that's assuming worst case, right? Yeah. So you could probably spend 5-6%. Yeah. And you wouldn't really see your portfolio go down because you got to think 5-6% return on my investments over a 30-year horizon. Yeah, it's probably doable. And so if you're spending 4%, you're going to have growth in that portfolio. Yeah. And you're going to die with more money than you have today, even though you're withdrawing from it.
I think it's 100% true. And yet I can't adhere to it personally, right? Because I don't want to play the odds with my life. Yeah. And when it comes to my personal and my family's financial independence and freedom, 95% is uncomfortable, right? Because that 5% chance of failure could be the financial crisis. It could be going on right now. It could just be that next war, right? I just love 100%. It's just most people don't have the luxury of 100%, right? Most people need to take some odds. They need to take some risk in order to enjoy retirement. And but it's difficult sometimes to psychologically accept that you have to take some risk, and it may not work out.
Yeah, no, and again, I guess it's human nature. You tend to look at the worst case.
Yeah.
But the worst case by definition isn't the median, right? It's the worst case. It's a tail in the distribution curve. The other thing I was going to mention, if you're struggling with it, that's fine. Just do your safe withdrawal rate. And if you're not quite spending it, but at a minimum, most people have unexpected income in retirement. I planned zero income, right? I wrote a book. I got this board thing. I got the blog, earning a little bit of money. None of those were built into our equation at all. So at a minimum, I would really encourage everybody to do this. If you get a little side hustle thing and suddenly you get a $10,000 pop in your checking account, don't save it. Why? You've already done your math. You never planned on that money. If it wasn't there, it wouldn't change your retirement at all. So now it's there. Well, put it into something, an experience. Take your grandkids to Disney, go on a cruise, do something with that money that's an experience, because you don't need the money anymore.
But then you don't have the scorecard anymore.
Yeah, I know. Right? See, it's following that net worth for all those years.
And that is so hard to give up, is to not save anymore. I mean, giving up saving and investing is just as hard as actually spending those dollars.
Yeah. Well, we talk about the transition into retirement and a life of not working versus your life previously of working. Really what we're talking about here is the other thing you just mentioned, moving from saver to spender, right? That's a part of it. The other big part is moving from years and years of accumulation to this, multi-decade decumulation.
Yeah.
And that's just as big. The tools are different. The mentality is different. The risks are different. All those transitions are part of retirement, right? And that's why you've got to think through all of these, because they all play a role in how much you enjoy your retirement.
Yeah. Well, Fritz, we've been chatting for a long time.
Always awesome.
I know.
I got to do one thing. Last time we talked,
it doesn't seem like we've been chatting that long.
I know. I got to show you how awesome Casey is. So when I was on 2 years ago, he mails this thing to me in the mail, and I was like, "What a classy guy!" It's a nice. I was in the aluminum business for 33 years, so it was near and dear to me. So I kept this, and when I knew I was coming up for this, I got to bring this to Casey and say thank you in person for writing a handwritten note on this pretty cool thing with your logo. That's class act.
Well, I didn't even think about you being the aluminum guy and how much you're going to appreciate the
amazing.
metal. So I'm glad I was able to still acquire the metal to get that out to you. Fritz, it's been awesome. I hope you decide to take this trip back up Fort Wayne sometime.
I love Fort Wayne.
And go live again.
Yeah,
you said you wouldn't be here again for another decade.
It'll probably be a while. I just happen to be in town, and normally it's not a place that we would, destination to go to, but I gotta say, I ran by the river this morning before our talk here. It's a nice city.
You may not know this.
Nice.
We were just voted top 10 places to retire.
I saw that actually. I thought of you when I saw that.
Yeah. I think we were number 7 on that list. Not due to the weather, but there's some other really good factors and things about Fort Wayne.
And the Howard Bailey broadcasting studio is in Fort Wayne. I mean, that's right. That's the biggest thing.
That's a destination.
I've seen it firsthand
in and of itself.
Casey, thank you very much.
Hey, thank you, buddy.
A pleasure.
Wrap.